Welcome back here with Money, and we're in conversation with Hrishikesh Parandikar this week to help us understand the demonetization impact on portfolios and the tweaks that might be required to ensure that you preserve your wealth and perhaps create some more of it. So Rishi, we've spoken about the fixed income asset class. Right. Now let's talk about equities. It's been a roller coaster ride since the 9th of November or the 8th of November. But in terms of asset allocation, are you advising a greater shift towards equity now?
So Surabhi, it's very hard at this point to take a view, right? I mean, like you have had lots of guys come and talk on your channel saying it's going to be there is no template to compare this against,
sure,
right, in terms of what happens. So I actually don't have a very well-formed view of saying what demonetization does itself to equities, right? And there is all kinds of predictions around what does it do in the short term. I think long term, all of us broadly agree that this is going to be it's a game changer, and it's a game changer for the positive. But I go back to my talk, my thoughts on the rates and the interest rates and everything. Yeah? In a low-yielding environment, in general, fixed income is not a great asset class for returns, right? It also has a positive impact in terms of corporate earnings.
Sure.
Right? And so if you just put those simple facts together and say, if you don't expect the economy's growth to dramatically fall off the cliff, if you expect borrowing costs to go down, if you expect sort of, in general, inflation to be fairly benign, all of those things put together are actually great for corporate earnings, right? Yeah. And so from that standpoint, again, taking a very safe 3 to 5 year view, equities, I would say, it's an extremely bullish case for equities.
Okay.
Now, clearly, we will see sort of palpitations over the next few weeks, few months, right? Perhaps a few quarters as well. But I would certainly say this is a great time to start to sort of, if you are already not exposed to equities, and people have been sort of waiting, there's obviously the markets were close to 9,000, they've come back down to 8,000. Yeah. People have been sort of waiting to get in.
Yeah.
I would say start to get in. There could certainly be times where it could go down a little bit further. But in general, my view on equities would be quite bullish.
So is there a ratio change as well? Let's say if the earlier advice was 60-40 in favor of equities, and I'm talking about someone with a medium risk appetite, I mean not very high risk appetite and not very conservative either. So for such an investor, is there a shift between the ratio of equity versus debt to what it is today?
So again, let's go back to the strategic versus tactical, right? So if the strategic was 60-40, my guess is at this point, given what's happened over the last few months, particularly as markets have softened, your tactical ratios probably already come down to a 50-50. As in 50 equities down from a 60 long-term target to 50. Now is certainly time to take it back to 60.
Okay.
Right? I think is where it is. And when I say now, I mean in the next month or two, right? There's going to be opportunities, I think, because the market's going to be sideways for a while, I would think.
Sure.
Now the question becomes, should you take the 60 up even more, right? In my view, yes. But again, it depends on, what life stage are you at, what your risk appetite is, what your goals are. Sure. But I would certainly see doing that, because again, we've seen the story play out, for example, in the US, right? Over the last 10 years in a low yielding environment, people have been forced to take money into equities, especially the older you get, which is when you've started to sort of accumulate, fairly reasonable amounts of wealth, which you then want to be able to protect and grow for your retirement. You have been left with no choice but to actually move more money to equity. So that 60-40 number probably goes to a 65 or 70 in a lot of cases.
Sure. And finally, on equity, how do you advise some of your HNI clients to play equity? I mean, is it all about direct exposure? Would you be looking at some kind of alternate strategies? How to play equity? I mean, private equity, listed equity? What are the options there?
So I think listed equities are a far better trade in India than a private equity, right, in general. If you're able to spend the time to be a little more than a part-time investor, then I would say go direct stocks. If you really don't have the time and the inclination, then trust somebody else to do it for you, right? It's a simple way to think about it. I think what changes also, and this is, I guess, a bit of a segue into a slightly different form of equities. In a low-yielding environment, besides direct equities, for the simple reason I talked about, are great returns, alternates start to become very, very interesting. And when specifically within alternates, I'm talking about fixed, sort of absolute return, not fixed, but absolute return products, which are currently yielding anywhere between 12 to 15%. Right? In a 10% competing fixed income environment, the increased volatility doesn't make sense. But in a again 5-6% competing environment, those things become very attractive.
Okay.
And they tend to be sort of fairly regular income. There is some volatility. Of course, they are by definition not capital protected, but that gets interesting, and that's a different way to represent equity. So it's a higher risk, higher return. Sometimes it can be higher.
Some examples of these products, typically, what sort of instruments are they investing in, and what are the costs involved from an investor's point of view?
So there are two ways to really play it, right? Professional investors do this by creating their own basket of options and futures and creating that, right? But that is not for most people. For most people, especially the HNI variety, there have been a slew of alternate investment funds, AIFs, which have been investing in different strategies. At the end of the day, those strategies tend to be market neutral, generally the classic hedge fund sort of variety, where they're going long and short on both sides, using a variety of different tactics, statistical arbitrage, event-based arbitrage, whatever the case might be, but generally not strongly directional. And those would be sort of the options to take, and those tend to return between, as I said, teens, with differing amount of volatility. Clearly higher volatility than cash and fixed income, but certainly sort of very attractive at this point.
And what about the tax implications? Because we've discussed that in fixed income and equity. Of course, that's not an issue if you're holding beyond a year. What about these products?
For now, it's not an issue, right? There's always been talk about...
well, fingers crossed, I think, from an investor's standpoint. But
And so... the AIFs, again, have different tax implications. So within AIFs, there is a category 3, which is where a lot of these long-short AIFs are. Right? If there is a component which is long only, that gets treated, and there is, that's been a sort of subject to debate, that gets treated in the long-term capital gains way. If that is the case, then instead of getting treated everything as business income and fully taxed, which is a 30 to 35% taxation, it tends to come down to closer to 15 to 20%. And so again, different funds have different tax treatments. Again, important to get into. But generally, if you assume it's a 20% type thing, those are very attractive then. They are better than fixed income as well.
Okay, all right. Well, we'll take a break on that note. On the other side, we'll get into a conversation on real estate. Is it going to be as disruptive if it's an asset class that you should be looking at or completely stay away from? And some thoughts on gold as well when we come back.